In a prior lesson, we discussed how to account for bonds under three scenarios: issuing bonds at face, at a discount, and also at a premium. And I said in that lesson that I would give you the mechanics of how you do pricing of bonds in a different lesson. So this is that lesson here. And you already have seen in that prior lesson that I gave you a scenario where there's a bond issue with a face amount of $1 million. The issue price, I told you back in that lesson that it will be $964 exactly, but actually, as you can see, is not really that amount. It's actually $964,000.56. The difference between these two amounts here would be the discount. So I'm going to just make sure that you see that. This would be the discount on bonds payable. Now, how do we get this $964.56? How do we know that that exact difference would actually effectively provide the investor with a 13% return, 1 more percent than the contract rate calls for? So that's what we're trying to do here, is trying to say, look, the bond contract rate provides the investor with 12%, but the market is providing investors 13%. How do we actually effectively make for these bonds to provide the 13%, even though the payments themselves are only based on 12%? Well, the difference between the 13% and 12% really is the difference between the face amount and the amount of proceeds from that initial loan. But it's not that easy to just say that's the amount. You have to actually calculate something, and I'll show you how to do it. Now, to do that calculation, you will have to realize that we're using periods of 6 months. So the term of the bonds are 5 years. The interest payments made on these bonds to the investor are 6 months periods. So that means that it is 10 periods instead. So that's really what we need to always remember. And because we're using 6 month periods, the rates we'll be using for the interest payment itself will be 6%, and eventually for the present value calculation that we'll be making, it will be 6.5%, which is half of the 13%. So keep that in mind as we move forward in this example. So now I'm going to show you how to come up with that 964.56 that represents that additional percentage return to the investor. So notice here that I'm going to actually first show you some guidance in general terms. I say to determine the price of bonds, if the market rate is not the same as a contract rate, compute the present value of the cash flows from the bonds. In this case, there are actually 11 cash flows. There are the 10 interest payments every 6 months, 10 times, and also the return of the $1 million face at the end of the life. So there's 11 of these cash flows. Now, if you take the present value of the interest payments and add it to the present value of the single face amount at the end of the life of the bonds, and you add them together, you would have the sum of the present values here. That's what this means. If you go and do the math, and again, I'll show you how to do this a little later, the present value of the interest payments would be a cash flow for 10 times of $60,000. So basically, we use $60,000 here in this calculation, and we use something called a present value factor for the annuity. We gather this from a present value table, and this will be another different lesson that I already have created that shows you how to select the correct present value factor for this calculation here. In this case, it will be 7.1888. If you multiply the cash flow of $60,000, this present value factor of this annuity, the present value for all 10 flows is $431,330. There's also the present value from the single return of the face to the investor at the end of the life, at the end of the 10 periods. So you have $1 million with a present value factor for a single amount of 0.5327. Again, I'll show you in a different lesson how to get to that present value factor. So the present value of $1 million 10 periods from now, today, is 532,726. When you add these together, that gives you the number that I showed you up there, 964,056, I believe. Now, as I said before, in a different lesson, you can derive those present value factors for the annuity over the single amount using either tables, or you can rely on these formulas. In a second, down below here on this spreadsheet, I'll show you how I did it using formulas, and I use this formula exactly to get to those amounts. So I'm going to go there now. Oh, by the way, here's the same thing I just showed you. Step one, first figure out what is the interest payment. So the face times the contract rate of 6%, that will be the $60,000 cash flow each period for 10 times. So again, I'll show you this calculation already. I'll show you this other calculation already as well, and that will be 964 here. Both together will give you the discount. Now, let me go and show you the actual calculation using this table here. Now, I always like to put the cash flows on a timeline so that I know what's going on. It makes it easier for me to do this. And in this case, I'm using a present value factor of a single amount for each of these separate cash flows. Since this $60,000 happens at the end of year one, of actually the first 6-month period, I put the 6,000 here, and I apply the present value factor of a single amount at period 1 and column, using the table, and column for 6.5%, and that will give me this present value factor for this specific amount, for this specific time. So the present value of $60,000 6 months from now today is only $56,338. The second one happens at the end of the first year. The second 6-month period is $60,000 again times 0.8817. That means that the $60,000 a year from now, in present value terms today, would be only at 6.5%, will be $52,900. So you follow the same approach each of these periods. As you can see, the further out you get, the less valuable today these cash flows become. So in the case of this 9th period cash flow of $60,000, the present value factor for this single amount would be 0.5674, and that basically means that this amount 4.5 years from now, or 9 periods from now, is the same as getting $34,041 today, assuming a 6.5% discount rate or interest rate. In the last period, we don't only get, or the investor doesn't only get the $60,000 from the interest payment, but also gets the face amount, and that's when you see the $1,060,000 here. The present value factor for that period will be 0.5327, and when you present value that, it will be 564,690. Then you add up all of these present values, and here's how you get the pricing of the bonds. Now, for the situation, for the premium situation, it will be the very same approach, except that instead of using 6.5%, you will be using 5.5%, and it will yield the same approach. I mean, it will require the same process, and then you end up with the exact present value of that, of those bonds. And let's see. I guess I'll stop at this point.